so we're starting a new segment here at Royal LePage Supreme called Facts, Stats, and Opinions. And our first guest speaker, I guess, if you want to call it that, you're a guest and you will be speaking. So our first expert is Stephen Elliott of Scotiabank, who's going to be sharing his outlook, I guess, on the rest of 2021 and sharing some facts and stats with us as it relates to what he does. And so I'll introduce Steve Elliott to those that don't know Steve. Steve, say hello and tell us a little about yourself.
Morning. So I am Scotiabank. I'm a home financing advisor, 30 years in the business, and specifically on the residential side, lending primarily in the GTA, but straight across Ontario and throughout Canada.
Good. And you're also, you know, we're friends, and you're a key partner with us at Royal LePage Supreme. You've been with us, my goodness, all 26 years of our history. Is that not the? That's accurate, isn't it?
That is correct. A valued relationship and friendship for sure.
Good. And you know, the fishing trip is just around the corner. Just friendly reminder. So, get into stats, Steve. Right now we have a surge in prices again. Early 2021, prices have taken off. All we hear is multiple offers, and in the core of the city and on the periphery. So if you're going out to places like Hamilton, Barrie, Innisfil, Durham region, anywhere you're going, even as far up as Cottage Country, there's a very low supply, which lends itself to multiple offers and thus a spike in prices. So we're in the middle of or late February, we've already seen a significant double-digit increase in prices. And I'm going to touch on some of the similarities to previous years, going as far back as December 2016, and sort of demonstrate some of the highs and lows, the supply and demand factors, and how one relates to the other, and how it all plays out. And then we're going to be sharing our opinions, which is what, you know, facts, stats, and opinions. I'll give you my opinion. I'll start with you. Interest rates are all-time lows. Obviously a factor in what's going on with the surge in buying. Tell us about a little of the past and where it's at today in terms of rates and activity.
Well, there's no doubt that we are at the lowest fixed rates in the history of Canada, and that's driven primarily by the whole pandemic issue that we've been involved with. We've got variable rate mortgages and fixed rate mortgages. The variable rate mortgages typically follow the Bank of Canada overnight lending rate, which affects prime with the bank. So typically, a change in the overnight lending rate with the Bank of Canada will follow with a similar change in the banks. That's not a guarantee that it's the exact same, but typically. So we have seen in history where perhaps a drop wasn't the same that happened on the prime side. So anyways, generally speaking, it follows. Fixed rates typically follow bond yields. So what are bond yields doing in the marketplace? Because lenders will lend out the money, but will also go to the bond market to obtain the money and then be able to lend against that. So bond yields have been, as we say, in the basement since since the pandemic. They've been going into the basement. So we've seen the fixed rates fall. Now there's other things that factor into the cost of the money, which is liquidity risk premiums, various things that get added to the actual cost of the bond yield. So without going into much description there, yes, we're seeing record low interest rates, and the question will be, where do we see them going in the future? If bond yields stay down, then we may see the rates stay down. I think that we'll see a bit of an uptick in the interest rates throughout the rest of 2021 as we see the bond yields increase. And bond yields can be driven by various factors in the marketplace. And, you know, just on a simple basis, if the economy keeps going, the vaccine is successful coming in, or there's the question of inflation happening. So will we see these rates stay at the lowest I don't think so. I think we'll see them start to creep up a little bit. It's just a case of where we go. Like if we have a 5-year fixed rate of, pick a number, 189 right now, will we see maybe 2.25 by the end of the year? Wouldn't surprise me. I don't think we're going to see any lower. How much lower can you actually go on the lowest in the history of Canada? So, you know, if you go back 2017, spring of 2017, that was a good time of comparison where they were, I'd say they were previously lowest rates. And, you know, you might have been 2.4 plus or minus on a 5-year fixed, but come the end of June, basically July 1st, rates spiked, and then the whole question of rates rising was on the platform. So spring of 2017, if you said the 5-year fixed rate was around 2.4, in spring of 2018 they were around 3.8. So we saw, what's that, 50% increase roughly, at least, in the interest rates. And then we expected the rates to continue going up, or economists expected them to continue going up, but then various factors happened in the economy, such one might say that various trade wars with a gentleman to the south of the border that was happening created bond yields or assisted bond yields or drove bond yields down. So then you saw interest rates then falling. Then March the 12th, when COVID really hit the markets, you saw fixed rates spike over the next week. So you saw in some cases fixed rates jump about 0.5% in just a week, and that's that bond yield driven. So that was that liquidity risk premiums or concerns about the cost of funds or what was going to happen with the funds in the marketplace. So after that was short-lived, and then we started to feel the light at the end of the tunnel coming out, and then you saw various government measures to assist the markets, and that, whether it be bond buybacks or otherwise, bond yields drop and fixed rates drop, and sure, variable rates drop. Now we're at that point of where do we go from here? And that's kind of the question, and that's kind of a loaded question as well, because where does the economy, where does COVID, where does vaccine, where does that all go from here? We're coming out of another gray lockdown, reopening up. Some wonder or concern that maybe we'll have a third lockdown in a few months. Again, what happens with that? If we do, what is the continued effect on the economy, on businesses and everything like that? But let's assume, for example, that we've got us coming out of the lockdown. Let's assume that the vaccines are kicking in. Let's assume that, you know, businesses are really opening back up. Then the expectation is that there's going to be a lot of pent up demand of people just wanting to get out there and get back to normal reality, whether it's buying just anything out there or whether it be buying real estate. So, but again, what do bond yields do and how is that driving? So I still think we'll see a bit of a creep up in mortgage rates, not significant, but just coming off the floor of where we are right now.
There you have it. You've given facts, stats, and opinions. So you're predicting a slight or uptick, as you said it, in the interest rate. I know that late last year, the U.S. Federal Reserve and the Canadian governor that monitors rates, they were both sort of predicting, especially the American, long-term to 2024 historic low rates. But of course, as you said, there's so many complexities to it. It's difficult to gauge. One thing that you mentioned was that on March 12th, when the pandemic hit, 12th of 2020, the market sort of reacted short-term, 2-3 weeks, and then it found itself to be sort of, you know, resilient. It adjusted as people adjusted, realtors adjusted, and at the end of the year, by the end of 2020, we had actually outperformed in terms of sales and average sale price 2019. So, and thus far this year, for anyone tuning in, if you look at the stats, the numbers are up again, and it's showing its resiliency yet again. And I believe that it will continue to do so. And on the heels of, as you said, a vaccine, we're, prepared, the consumer's prepared and saying, okay, we're doing this safely. We're going to navigate through these waters safely, cautiously. We're going to do what we need to do. And there's been an adjustment in how people are reacting to this, the what you call exodus from GTA. There's an influx and there's more coming in terms of immigration, but so the pandemic did shift or adjust the consumer behavior.
Yeah, absolutely. We and I spoke about this many times when the pandemic hit. Coming out of call it May, I said this isn't a stop in business. This is for many types of companies, real estate, car sales. This is a pause, or it was a pause at that time. And each lockdown, in a way, it's a hard pause, but in many cases, it doesn't take away the buyer behavior that will be going on. So if you had, for example, 10 people that wanted to buy a home or buy a car in 2020, the majority of those still wanted to buy. Some may have been affected, but you had a pent up demand from the lockdown. And, all you had to do is just look at the outside of Toronto anyways, all you had to do is look at the regions that were open this past weekend. There was a lot of pent up demand out there in the stores, in the shopping malls. People were out, whether they wanted to be because they wanted a place to go, or whether they wanted to get out there and buy. I know I had deferred purchases and I went out and did a whole bunch of buying on the weekend. So pent up demand from that standpoint. But you talked about buyer behavior as well. As we've shifted away from the so-called downtown or the metropolis areas of employment, never in my career have I seen a shift in buyer behavior as we've seen in the last 10 or 11 months. And that is people moving further away from the office because they either don't need to be at the office or they don't need to be at the office that much. And from that, they can live further away. They're more than happy to take a train in if it takes an hour and a half, one day a week or every 2 weeks. But also from secondary home buying. The secondary home buying market has just been on fire. Call that cottage country or call that just anybody where people can get away and have away time or relaxation time. And people aren't traveling, so they're not going here. So, for example, somebody that might have had a ski chalet on the other side of the border now wants to buy a ski chalet on this side of the border because they can get to this one. They can't to the other one. Same thing as, buying a cottage. But those markets are absolutely on fire. And as you said, there's not a lot of supply. And that can be possibly by some of these properties coming on the market, being purchased before they even hit the market. Right now, possibly it's just because we have a lot of snow on the ground, and that pause or pent up demand will happen maybe in a month or so. But change in buyer behavior, absolutely. What we have to be careful of is if the vaccine comes back and then we return to work, so to speak, we return to the office. Will we return at pre-pandemic levels? For example, downtown corporate office building at the same amount? No, I don't think so. That'll take a very, very, very long time to come back. But will there be an increased need to be at the office? Quite possibly. So does that have a reverse effect on what we saw in the last 10 or 12 months? Again, we'll see how this plays out. Maybe there's the odd buyer out there that thought they bought a cottage and that was the thing they wanted to do. And maybe in a couple of years they say, I thought that's what I wanted and maybe I want to sell it now. But those things are normal things that we'll see play out.
Yeah, it's interesting. I mean, it may not be a permanent shift. The consumer that's was maybe living an hour from the office or downtown may have moved out 2 hours, say I can work from home. We can both work from home. That may shift again, depending on, how quickly things get back to normal in the core. I can't necessarily imagine the downtown core and the whole banking sector and the insurance sector being entirely vacant for extended and prolonged periods. So at some point, there may be what we call a recall. But I wanted to touch on the supply, and you mentioned, and I want to get into the correlation with the supply and demand factors and the pricing. So if you're looking at, I'm going to take you back as far as 2017, you mentioned detached active listings in Toronto, so Toronto only, detached only. In January 2017, we had 543. May of that year, and there were the government measures to sort of slow things down. So May detached went from 543 to 2242. So it's a significant increase in a short period. You go back to January 18th, you go from January 18th, 1,271 detached units available. May of 2018, you had 2,300. And 19, you have the same sort of 1,300 to 2,400, January to May. And last year, we had 926 units available in Toronto in January. And in May, we had 1,266. The correlation with that is the pricing. So in the beginning of the year, we had mid-March last year, we had a 15% increase in the market. And then COVID aside, COVID obviously stalled the market. We still had an average sale price of over 11%, I think, in 2020. And again, I've already mentioned that we had 95,000 sales. So the caution here is, do we anticipate that this is going to go, steadily increase month after month until December of 2021? Or as the stats will bear, we're going to get to a point soon where an increase in the supply is going to soften the multiple offer and the competition, soften the prices a little bit to a more balanced, maybe more buyer-friendly way, right? And that's what we've seen since 2000, historically, the last 4 years. So, and you mentioned there's so many different things going on. You have the boomers now who have been hanging on with the millennials living at home until late 20s, early 30s. The millennials are leaving now. So the boomers are maybe buying that cottage property, or, they may be leaving. So it's going to be an interesting year, some of it, or a lot of it, driven by, the COVID, but, a couple of cohorts going in different directions, the millennial and the boomer. And it's going to be interesting in how it plays out in terms of supply and the demand. And if we, as you said, have historically low rates, where do we see December of 2021? Where do we see it in terms of how the year played out? Is it going to be up in terms of sales, overall sales? I suspect it will, and that, the segment of my opinion is that I think we'll see a softening in the price side, directly correlated with an increase on the supply. So, and as you said, and are predicting that the rates will remain low, it's going to be a better late spring and summer for the buyer.
Yeah, absolutely. You've got, the question becomes, what increase in interest rates can be absorbed by the market to keep it still as a high demand marketplace, meaning people motivated to buy, or and to what point it eclipses that interest rate level that now people start to say, well, now the rates are starting to be a little too high. Like if you compare 2017 and 2018, the rates in 2018 obviously had an effect on people's buying behavior versus spring of, say, 2017, end of 2016. So if we had, for example, a 0.5% jump in fixed rates, would that affect the real estate market? I don't think so, because we're still going to be at low historic rates and we can absorb. But if we jumped, 3% and higher, will that affect it? Quite possibly. And do we expect it to go that high? No, not necessarily. But again, there's so many factors that can play in here about the return to the strong economy, or for that matter, just too much inflation. The other question is, do we have increased defaults based on the lockdowns, based on the deferrals that had happened in the marketplace? And if you look at deferrals in 2020, of all the CBA member banks, there at the end of December there were 799,700 deferrals that had happened. So call it 800,000 deferrals. That was 16.7% of
We have a technical glitch.
pockets. So yeah, I'm still, yeah, sorry, you froze up there a little bit, so I wasn't sure if I was still there. So now those deferrals are done. There are exceptions that are still being done, but the mass deferrals are done. So what happens now? Are people back to affording everything? Are people running on credit that otherwise is getting used up, and they may run into the hurdle and increase defaults? Sure, there may be some of that, but I don't think we're going to see that in the doldrums or the doom and gloom predictions that some people made in 2020. One notable person said the deferral cliff, and I think we've seen that it's not necessarily going to be a deferral cliff, but more of a deferral dip. And so will there be some people? Sure, but in a strong marketplace, those that can't afford it will likely end up selling before they default. In a down market, in times of a recession where prices are falling, that's where you'll see increased people or increased borrowers walking away. So as long as there's equity in a property or increasing equity in a property, they can sell and create the supply going into the economy. But at the same time, I don't think that we're going to have that great big doom and gloom happen. There'll be examples of it, but not overall.
Was the person that predicted the cliff the same person that predicted a 10% decrease in the average sale price in Toronto?
You're correct.
It was more institutional than the person, but yeah, you know what? So mortgage deferrals, and I'm glad you touched on this. They started early pandemic, and it was a 6-month deferral. Statistically, there were no cases, or very, very few cases, untrackable amount of cases where the mortgages went into default. People then, and it was September of 2020. On the American side of things, there were some defaults. There were like single-digit 3% defaults happening. Nothing trackable in Canada. And at the time in September, people were already saying, well, the minute these people have to start paying back, there's going to be the cliff, and it didn't happen. And as late as 2020, December 2020, a Royal LePage report that was released, there was no trackable evidence of any defaults from the people that had deferred. So that's good news. In some cases they could have refinanced because the rates kept dropping. It bodes well, or I guess it demonstrates that the economy was resilient. People went back to work, and there were no defaults. So that was tremendous news for homeowners and for the Canadian economy. So there was no trackable evidence of any bad things happening.
Yeah, and you've got kind of two areas to look at right now. One is, where are rates down the road? And I mean down the road at maturity. So if somebody got into an interest rate with a 1 in front of it today, and interest rates in 5 years happen to be, let's just say 3.5%, borrowers have to be prepared that the odds of the rates being at the lowest again at maturity are slim to nil, in my humble opinion. So every borrower should be looking at it saying, what am I going to do at maturity? How am I going to save and prepare until then? Maybe, in some cases, if your payment is $2,000 a month at today's interest rate, and it's maybe $2,800 a month at a high rate, maybe because the sun's shining with a low rate, we should be putting a little bit more towards our mortgage now to buffer or into the bank accounts or into investments, and at least be prepared for that payment shock that might happen down the road. So we'd be naive to think that the affordability of today is going to continue for the whole length of the borrower's mortgage term. So just heads up, be prepared. That's my advice. The second thing is, many have asked why the stress test, the government stress test benchmark rate has not fallen. And I think that is the whole idea behind it. You know, we've seen it slip a little bit from maybe 5.19 down to 4.79 as a qualifying rate. But that stress test was, it came out based on the premise that we want to qualify you at, let's just say, 2% over the rate. Well, we're far, that benchmark is way above that 2%, right, or 2% spread right now. But if it was lowered too much, you would have too much qualifying, too much buying at this lower interest rate right now. So keeping it relatively where it is right now essentially is helping factor in that possible payment shock down the road of higher rates. So if we're saying to a borrower, you need to qualify at 479, if rates are higher in, say, 5 years when maybe their maturity date happens, then by that qualification, they should be able to afford the higher rate. If that stress test came down to, say, 3.8% and rates happen to be 3% down the road, I think that's where we would have a bigger effect on the mortgage market, the default scenario, maybe 5 years from now. So I tend to agree with the government in keeping that benchmark rate unchanged, making sure that we adjust for the reality that what may come down the road.
Yeah, it's one. In spite of the gap being, as you said, a little bigger than intended because of the drop in the rate, people are still, qualifying. People are buying, outperforming. 2020 outperformed 2019, and so far this year sales are already taking off. So it's good that we have those measures. Otherwise, everybody be jumping in and then potentially causing some sort of economic, would have some sort of impact in anticipation that the rates may increase, and that would cause some defaults, as you said. So your advice is use the prepayment privilege, pay down your mortgage as much as you can, utilize the difference in the rates from last year to this year, whatever you're saving, put it into your mortgage, and maybe defer that big boat or the motorcycle purchase.
Or save it aside, right? So as the saying goes, either pay down your debt or save it in the bank account or investments. Don't just go spend it all. Now, for everybody has to afford things, and that's a reality. But if there's the ability to set aside, pay down, just be prepared, then that's great. But if we're taking on more debt at a time when the rate is the lowest in the history, and then rates are higher at maturity, that's a big thing to absorb. So my caution to everybody is just be prepared for a higher payment, higher rate. And I work through customers, and when we're going through the mortgage financing, to say, what if rates are this much down the road? So if your payment is $2,000 now and rates are this, and maybe it's $2,600, can you afford that? And it's discussion, right? It's just making sure we're not being naive that this is my payment and this is my rate for the whole existence of my mortgage.
Forever, yeah. Just a little word of caution, I guess, and I think it's good advice or something to sort of look out for and prepare for. And I would use some. I'll give you some caution on my side as well. Now with the market the way it is, I think consumers, us realtors, have to consider: do we buy first? Do we sell first? You have to weigh all the factors in anticipation that there will be a rainy day in the market. As you're saying, a rate increase. What's our rainy day? Our rainy day is a more balanced market than having sellers that have bought and have to dispose of some real estate because they don't want to carry both. Just being cautious that this is not always going to be up and up and up. It's not going to be sunny days. There will be some rainy days. So my advice would be measure, moving forward as we get into spring, and you look at the stats from 2017 up until this January, with the supply and demand forces, a little word of caution would be, consider, can the seller afford to buy and risk selling if the market were to sort of balance itself and potentially, lose an anticipated chunk of appreciation that could just be wiped out overnight, as it happened in 17 and every year since then. So be cautious. Your word is cautious, my word's cautious. Don't expect, a steady increase. Sunny days, there will be some rainy days, there will be some turbulence in the market and balances. So just be cautious, be wise, and anticipate that things will change, not might change, but will change.
Right.
Steve, we've gone over our 10-minute limit. We had this 10-minute slot, which is, we can talk about this stuff forever. I can see your passion, for it. Normally we'd be in suit and tie, but here you are, both in need of a haircut and wearing our more casual attire. But it's good to see you on. I appreciate your insights and your expertise. It's good to hear it. It's positive news coming out of you, but always with a word of caution. And I don't know when we'll see you back at the office, but we're looking forward to those days as well. And
how about at 4 o'clock?
I've been sitting here for 15 minutes and that clock hasn't moved, right? It's 3:30 somewhere, and it's been 3:30 here for
I did that on purpose to show you that time stands still when we talk.
Well, it just flew, actually. Any parting words? Anything else? Consumer advice, or just anything forecasting?
No. You know what? You said it. You hit the nail on the head. I am positive, and always with the word of caution. Don't get in too over your head. But I am very optimistic about the real estate market this year. Rates this year. Sure, the numbers going to adjust a little bit up or down. Sure, but overall, like I said, lockdown aside, that creates pent-up demand, whether it be in real estate, whether it be in other purchases that need to happen. And I think we're going to see a great 2021, and we're all looking forward to getting back to some sense of new normal where we're hanging out again.
A new normal,
Yeah.
Indeed. So once again, thanks, Steve, and I'll leave you guys with this next session of Facts, Stats, and Opinions. We're going to be joined by a real estate lawyer covering the status certificate and do's and don'ts, and some insights on condominium purchase and or sale. So thanks for tuning into our first session. We went over, but it was informative, I trust. We'll see you next time. Steve, be well.
You too. Bye.